Hello, welcome to a new video of Dividend Data, but this video is going to be a little different. I'm going to be doing a little bit of a question and answer session, so let's jump into it. All right, welcome to a Dividend Data fireside chat hosted by yours truly, Zach. So I wanted to use this as an opportunity to reconnect with the audience a little bit. I'll be taking questions on a bunch of topics, of course, including investing and stocks, but also business, life, etc. So I dropped a YouTube post earlier today asking for questions from the audience, and here's what they said. We have a question from Joshua Lopez, 22 minutes ago, so you just made the cut. He said, I'm new to stocks, so I'm just wondering what platform or broker you are using and which you think I should avoid. Well, if you're starting investing, I guess this is question number one, but it's also probably the least important question, and you really should not spend a lot of time thinking about this, in my opinion. You want to get straight to the task of investing. It's like if you were going to start a business, but you spend all your time researching where to set up your LLC. But for my brokerage, I personally use Merrill Edge, and that's because it's connected and integrated very well into Bank of America, which is where I do almost all of my banking. I also feel a little bit more comfortable being connected to one of the too big to fail kind of banks in the US. But in terms of things to avoid, the main things to avoid are anything with commission-based trades. Most brokerages these days have no commission, at least in the United States. And then if you're a newer, smaller money investor, then you should probably also look for a brokerage with fractional shares. Merrill has fractional shares for dividend reinvestment, but not for buying full shares. But many other brokerages do. Fractional shares is becoming more and more popular, so probably look for that. And if you're younger and want to use a fintech app or anything, then I would suggest using Robinhood or M1 Finance. From what I've seen, those are the best brokerages for the average person getting started. Robinhood does have more of a focus on trading, while M1 Finance is more oriented to the long-term investor. But in my opinion, this actually does not really matter at all what your brokerage is. It's just the vehicle through which you get started. And then the real journey begins. Question 2 from Dividend Dude. What's the long-term plan for how the best stock analysis platform, Dividend Data, will look over the next several years? What are some upcoming updates? Well, thank you for asking about dividenddata.com. And first off, I would just like to thank everyone for all the support over the past month during the launch of our new AI tool, plus the Black Friday sale and Cyber Monday sale. That just ended and the support was fantastic. Over the past month and 3 days, we grew active Dividend Data memberships by 47%. But what I'm even more excited about is that daily usage of the platform is up over 100% in the month. And a lot of that is from our new AI analyst, where you can basically ask any investing question. It can summarize earnings for you. It can give you an overview of a business. It can help you value a stock doing discount cash flow. And it can help you screen for different types of stocks using hundreds of different financial metrics. So over the short term, the main focus with dividenddata.com is making sure everyone understands and can realize all the functionality of the AI tool. So I'm going to be creating more cheat sheets and prompt guides, so you have example prompts of the different ways you can get value out of the tool. And I do think that's pretty important because it's rather novel and not everyone has that in their workflow right now. And then another big thing that I think will be important is adding more brokerage support for dividenddata.com. That way more people can choose to track their portfolio. I don't know if I want to give you my 7-year roadmap here, but I'm pretty excited about the future. Right now, the motto is more better. So you're going to be getting more free content, more features on dividenddata.com, and also better content and better features. I worked really hard this past month or so with the AI launch and Black Friday sale, and you probably noticed with the increased video output as of late. And I'm definitely excited with the results so far of the sale. But I'll tell you what, I'm more excited about what this means for the future, because when I started this, I knew nothing. If you were a beta tester on the original dividenddata.com, oh my God, I'm sorry for you. That was the first tool I had ever made. And it really has just gotten so much better. And I've learned so much along the way, like a crazy amount. You would have no idea how much goes into this stuff. But the exciting thing is that this is still just the beginning. If you signed up recently, then think of yourself as a founding member of Dividend Data, because I think we're about to enter a pretty solid season of growth ahead. The product is the best it has ever been. I've learned so much along the way. I feel like I have a pretty clear growth plan ahead, and I just gotta execute. If you've been using the tool a lot lately and enjoy it, then please tell other people. I don't know if you guys want more business behind the scenes stuff. I would be happy to do that in future Q&A videos. A lot of work ahead, but we are definitely rolling in the right direction. All right, question 3. What are the red flags when analyzing the dividends record of a company? So this kind of depends on your investing goals. If you want a stock that continually increases their dividend payment and it's reliable, then the red flags you would be looking for are companies where they have irregular dividend payments so that it goes up or down depending on how their earnings go over time. That shows that that payment would not be reliable. There's quite a few oil and gas stocks where that happens, where they pay massive dividends when the company has high earnings and then they cut them completely when they're not doing well or losing money in a bad oil market. Other red flags to look for are extremely high payout ratios. That would be based on both free cash flow and net income. Anything where it's over 100% consistently, then you know that's probably not a sustainable dividend payment unless they start making a lot more money very quickly. And in many of those cases, it's likely being funded through debt, which is not sustainable. All right, question 4. I was thinking of buying Visa, ticker symbol V, but they went up by a lot not too long ago. Buying a single stock of Visa would be a big part of my portfolio. So should I wait for a dip or invest in it now? Well, if a single share of Visa would be a big part of your portfolio, then obviously you should be way more careful about buying that. And as you know, this is one of the bigger stocks in my dividend growth portfolio, and I do feel pretty comfortable about the business. I do think it's trading at a slight premium, but I wouldn't say that it's overvalued necessarily right now. And again, this is not personal financial advice, but given that you're at a very small dollar amount right now, then I would really just play it slow into getting into the market. And there's nothing wrong with a dollar cost averaging approach. You should probably check if your brokerage has fractional shares as well, so you don't have to buy a whole share. But it sounds like you're in more of the beginner phase, so I really would focus on just learning more about it. And you can learn by doing. In my opinion, the best experience with investing is actually trying to invest your money. And if you're watching this channel and thinking about investing in a stock like Visa, then you're not going down the crazy YOLO meme stock, leveraged margin play, options, blah, blah, blah. So you're probably not going to blow through this anyways. But my number one advice for anyone starting out is focus on increasing your own personal income. That will often have a much higher return than how you invest that money. When you're at very small dollar amounts, it's probably best to invest in increasing your own income through skills and education. And then the cash that you do have left over, follow a very simple investing strategy, whether that's the S&P 500 with a couple of individual stocks that you pick out. Hope that helps. Again, not personal financial advice. Question 5 from Noel Ninder. If I intend to stay in the market for 15 to 30 years, should I go with a 100% growth investing and then sell it for later for a more dividend-based portfolio? I'm thinking that with taxes in mind, it would be better to go with growth stocks and not paying taxes on my dividends if I'm just planning on reinvesting them. Love the vids. All right, well, Noel, you can do whatever you want to do. There's nothing wrong with growth investing. It's fine. I have some of my portfolio allocated to growth investing. I don't think that your tax reason was necessarily the best reason, because if you're going to be selling your growth stocks at the end, you're going to be paying at least 20% in capital gains on what would be 20 years of gains, versus if you buy dividend growth stocks that compound over time and you keep them and then live off the dividends or continue reinvesting the dividends in the future, then you wouldn't have the capital gains of selling the entire position. You will have the taxes on your dividend income, which in the US is the lowered qualified dividend rate, which is nice. Plus you have this constant stream of income that piles in that you can use to reinvest, and that can add a very powerful compounding effect to your portfolio over time. So even if we are in a great financial crisis, 2008 type environment, you'd have all this dividend income coming in and helping you buy more shares of stocks at that low. Versus if you were entirely growth stocks in that environment, then who knows, your portfolio could go down 70% or something if they were in more risky assets, and you would have no extra income helping you in those times. So I think dividend growth investing in general is a much more reliable and sustainable path to compounding. But I would say that you're thinking about it in the right way, where you do want to optimize for total return over that 15 to 30 year period. And that's really how you should be thinking about it. You should be thinking about it in terms of your total return. And there are high quality growth stocks that can get you a great total return, but there are also high quality dividend growth stocks that can get you a great return. And in general, when I'm analyzing stocks, I know that's kind of ironic because my channel is dividend data, but I try and don't categorize them as dividend stocks, value stocks, growth stocks. They're all just businesses, and they're at different phases of life in their business. They all have different financial characteristics and business models and growth rates. So I definitely wouldn't be worried about your tax reason that you gave, but it's something worth thinking about. Question 6 from Michael Richard. If you were to compare strategy 1 equal portfolio of only dividend paying stocks, balancing above average yield and dividend growth, or strategy 2, 50% growth plus 50% low yield, with the plan to sell these in 20 years time and then invest purely into dividend stocks, which one would you recommend for people your age? Again, I think it's all a valid strategy, not personal financial advice, but this is kind of repetitive to the question I just answered. A lot of this really just depends on your personal goals. Are you trying to live off dividends soon? Are you optimizing for total return over 20 or 30 years? And that will impact slightly how you change your strategy. You can look at the bulk of my portfolio, and there are a lot of low yielding, high growth companies with a couple low valuation, high yield companies like Altria, ExxonMobil. But I don't know why I really don't like this mindset of you're building up this whole portfolio to sell in 20 years to then put in different kinds of stocks. Again, I really don't think about investing at all in this way. Your portfolio is something that you should be constantly somewhat evaluating and evolving your strategy. And you got to think about it as a basket of businesses. Some of them pay you cash flows, and some of those even grow very fast as well. And then others aren't at the stage where they're paying back dividends to shareholders, but they have a lot of promise and growth happening as well. But back to part of how I answered that prior question, I do think dividends are very useful and the cash flow they pay you in any kind of recession or bear market because it gives you more cash to invest at those lows. And I think if we got into any prolonged bear market, dividend stocks would be really helpful compounding during that time, at least some amount in your portfolio. Question 6. From Jay-Z, lots of numbers. What practical strategies do you use to stay grounded in a bull market like the one we are in right now? Well, we definitely are kind of in a bull market. We had 2 years of the S&P 500 growing over 20% a year, which is pretty historic. How do I stay grounded? Well, if you've been following the channel, you know that I've been investing a little bit less into the market right now. I've been focusing more on reinvesting into myself, into dividenddata.com, and improving my income earning. And I do think investing into yourself, especially if you have a business or some way to get skills that help you earn more money, then that's always a great strategy in any market, especially a bull market where you may think some stocks are overvalued. But in terms of that question of whether or not you can even invest in the market right now, there are always some opportunities. Now, it can be very difficult to evaluate the market indexes and whether or not they're overvalued or undervalued. But if you're doing the index approach, you should probably just dollar cost average anyways. If you're picking individual stocks, then you have to focus on each individual business. And I do think there's quite a few opportunities right now, even in a bull market. You can even argue that one of the Magnificent Seven stocks, Alphabet, is a pretty good value right now. I've covered Hershey recently on the channel. You could make the argument that's a good value. And this is where I like the stock picking approach in that you can just focus on the actual businesses and you don't have to worry as much about what the rest of the market is valued at. Question number 7 from Jesse Scott. Do you have a target dividend yield or are you more focused on the long-term stability and growth of the dividends? Are there any short-term investing strategies you use for dividend investing? No, I personally don't have a target dividend yield, but that's because I'm in the phase where I'm focused on optimizing for total return of my investments. So I'll have anything from a 0.5% dividend yield to a 10% dividend yield. If I was closer to retirement and wanted to live off of dividend income, then I likely would have a target dividend yield set. But even then I would be a little broad with it because you're looking for that combination of yield and growth. And then to answer your question about the short-term strategies, there are not any that I personally use, but I know people that do the dividend wheel, which is this whole strategy you can look up. Plus short term, I would throw a lot of dividend strategies into the short term, whether it's these like yield max ETFs that like pay crazy dividends, but then the value plummets. I would consider that to be a short-term strategy. I personally don't really do any of that. Question 9, I'm from Sweden and the EU have made regulations toward USA ETFs. So I can't invest in popular dividend ETFs like SCHD. What are some other alternatives you would recommend that is approved by the EU? Well, dude, off the top of my head, I have no idea. My main piece of advice would be move out of Europe. Come to the USA, declare your independence. I have a little declaration of independence up there. I don't know, but I'm sure you could ask Dividend Data, the new AI tool, and figure it out. All right, let's end it here with question number 10 from Grim Gamer XD. What are your thoughts on the recent Elon Musk compensation package ruling? So if you guys didn't see that, for the second time, the Delaware judge ruled that Elon Musk's compensation package was not valid, even though it has been repeatedly voted upon by shareholders of Tesla. I was one of them. I voted for the compensation package, and the ruling is just completely ridiculous. I don't want to go into all the details. That could be a video itself, but the compensation package was really the most shareholder-friendly deal that could possibly happen. He took no salary and then had to hit these crazy milestones in terms of market cap and business goals. And he did it. And we shareholders made a lot of money along the way. So personally, I would like to see another version of that compensation package where it set targets for Tesla to hit a $5 or $10 trillion market cap. There are so many examples too of CEOs getting paid $20, $30, $50 million, and the value of the business for shareholders has declined massively during that time. I think it's awesome when the incentives are perfectly aligned with one another. Also, it's pretty obvious that a Tesla shareholder wants Elon Musk to be involved in Tesla. There's just massive key man risk and upside associated to whether or not he stays on board for another decade or two. All right, that is going to be the end of the video. Thank you for watching Dividend Data. If you comment below, I'll probably use those as questions for my next Q&A video. And again, I really just want to thank you guys for all the support with dividenddata.com over the past month and a half. And really, in the years since I started developing it, it's been a massive learning experience, and I'm just so pumped about the future. So with that said, I'll see you in the next video.